Most people never give real estate investing a second thought because when they hear real estate investing, their mind goes to tenants, toilets, and turnover. What if there was a way that you could diversify your portfolio through real estate and not have to worry about any of that? Receive all of the benefits without having to deal with any of the stuff that drives most investors away. So, what's the answer? Real estate syndication. My name's Tom Googe, and I'm a seasoned real estate investor. And in this video, I'm going to deep dive on this topic. I want to arm you, the investor, with all of the relevant information that you need to determine if this type of investment is for you. So let's dive in. All right, so first, let's level set on real estate investing in general. Real estate investing, it's all around us. It's the homes we live in, the office buildings we work in, the factories that produce our goods, and the retail stores where we shop. So what exactly is real estate investing? Simply put, it's the process of purchasing properties to generate income or profit, whether through renting, resale, simply holding on to them as they appreciate in value. It's like buying a piece of the world and watching its worth grow. Investing in real estate has several significant benefits. First off, it provides a steady stream of cash flow in the form of rental income. Secondly, as properties appreciate over time, you're not just maintaining your investment, you're growing it. And furthermore, real estate can offer tax advantages, and with the right strategy, it can be a great hedge against inflation. Now, not all real estate investments are created equal. There are primarily four types. Let's dive into those. We have residential and multifamily, commercial, industrial, and then retail real estate. Residential properties, those include houses, apartments, townhomes, and so on. Essentially, that's where people live. Now, commercial properties, those consist of office spaces and skyscrapers. Industrial properties, now those encompass warehouses, manufacturing buildings, and distribution centers. And then lastly, the retail properties, those include shopping malls, strip malls, and other retail storefronts. Each of these types, they have their own unique benefits and challenges, and savvy investors, they often hold a mix of these in their portfolios. And I really think that's the key, right? Diversification. Real estate plays a crucial role in a diversified investment portfolio. And why is that? That's because real estate can provide stable returns that are less correlated with stock and bond markets, and thereby it's reducing your risk. Even when stock markets are volatile, people still need places to live, work, shop, produce goods. This means that your real estate investment can continue to generate income, providing a cushion during more turbulent economic times. So, what is a real estate syndication? In essence, a real estate syndication is a partnership between a group of investors who pool their resources to invest in properties and projects larger than they could afford or manage individually. Think about it like as group buying power is the best way to say that. But okay, how does it work? The structure of a real estate syndication is split primarily into two roles. The general partners, those are often known as sponsors, you'll hear them called. And then the limited partners, or you, the investors. Now, the general partners or sponsors are the deal makers. They identify the investment opportunities, they secure the financing, and oversee the project's operation. The limited partners, on the other hand, are the silent partners. They provide the majority of the capital, but do not participate in the day-to-day operations. Back to the whole tenants, toilets, and turnover, right? So why consider a syndication? Well, syndications allow individuals to invest in large-scale, high-return properties that would typically be out of the reach for just a solo investor. So think large commercial buildings, apartment complexes, retail centers. In addition, since the sponsors are often experienced real estate professionals, the investors can benefit from their experience without having to actually manage the property themselves. Once again, we're circling back to the tenants, toilets, and turnover. You don't have to be an expert in that area to participate in this investment. Your sponsor has your back in that area. But how does it compare to other forms of real estate investments? That's the question that you're going to have immediately. Well, let's take real estate investment trust, or you'll hear them referred to as REITs, right? You're like, what the heck's a REIT? That's a real estate investment trust. So for example, both syndications and REITs allow investors to pull resources and invest in large-scale properties. However, unlike REITs, which are more, they're a little bit more passive and they behave a little bit more like buying a stock, syndications offer and provide investors with direct control over specific properties that they're investing in, which is, should be very attractive for you. Or let's consider investing in a single property. As a solo owner, you're responsible for all the costs, all the decisions, all the risks. In a syndication, you share those responsibilities, and while your potential profits might be divided, so are your potential losses. Like all investment, real estate syndications come with their own set of risks and rewards. They require due diligence, understanding the property market, and trust in syndication partners, right? You have to trust in those sponsors that you have. But with these in place, syndications can open up a world of opportunities that would have potentially been beyond your reach. Now, let's talk about the players in a syndication. In a real estate syndication, there are two main roles. We briefly touched on this. Those are the general partners and also, known as sponsors, and then the limited partners or investors. So first, let's talk about the general partners or sponsors. These are the professionals who form the syndication. They locate the property to invest in it. They manage the day-to-day operations, and eventually they're the ones that are going to sell the property. Now, the responsibilities of the general partners, those typically include the property acquisition, obtaining the financing, the property management, the legal compliance, the financial reporting, pretty much all of the day-to-day activities and the week-to-week and month-to-month and quarterly activities. And ultimately, they're the ones executing the exit strategy. Your general partners, they're the ones at the helm steering the ship. Now, what qualifies someone to be a general partner? Well, there's actually no set in stone qualifications. Successful general partners often have significant experience in the real estate industry, and to match, they have a proven track record of successful investments. They're also going to have a deep understanding of market trends, strong relationships with banks and lenders, and of course, robust leaderships and management skills. So they're bringing a ton to the table, right, as the general partner. So in essence, the general partners are the experts. They have their fingers on the pulse of the real estate market and the skills to navigate the ups and downs. Now let's shift our focus to the limited partners. These are the investors, that's you, who provide the majority of the capital for the investment property. Your role as an investor is a significantly more passive one compared to the general partner. Limited partners, they contribute capital and share in the profits, but they don't take part in the daily operations or the management decisions. The investor's main role, it's to perform due diligence before investing and ensure they trust the general partners, both their skills and the strategy that they're presenting to you. Who can be a limited partner? While regulations may vary, typically anyone with the necessary capital can invest as a limited partner. With that said, many syndications are only opened up to what you'll hear as accredited investors. And those are individuals who meet specific income or net worth criteria set by the Security and Exchange Commission. And the best way to think about this as an accredited investor, and we'll have videos that deep dive on this. When you think accredited investor, the definition from the SEC at this point in time is someone who has a net worth of $1 million or more, and that excludes their personal residence. In addition to that, an accredited investor can also have, whether they're married or single, have a certain amount of income coming in per year that also can meet those requirements. Once again, we'll deep dive in on that on a separate video for you. But essentially, limited partners, it's a diverse group, from high income professionals who want to diversify their portfolio to to the actual seasoned investor looking for passive income, and also, heck, retirees aiming for a steady return. We're no longer in the day and age where you can, count on a pension, right? You're trying to count on your 401k, and more often than not, as we've seen, right, that can dip very quickly and then, hurt, what you were expecting for your retirement. That's where the real estate syndication really comes into play. So there you have it. A closer look at the key players at a real estate syndication, understanding the roles, the responsibilities, and the qualification of each player is essential to successful syndication investing. All right, so next, let's cover how a real estate syndication works. So how a real estate syndication works, we're going to cover the processes and the steps. So the syndication process typically unfolds in 5 main stages. First is the deal sourcing. the due diligence, acquisition, and operation. And finally, what we talked about, the exit. All right, first up, deal sourcing. This is where the general partners put their expertise to work. They actually scour the market, they leverage their networks, and they use their industry knowledge to identify potential investment properties. So this could involve everything from online research to attending real estate auctions to networking with brokers and direct outreach to property owners. Once a potential deal is identified, the syndicate moves into the due diligence phase. This is a critical step where the general partners conduct a comprehensive review of the property. And this is where you'll often hear, hey, if the numbers didn't work, we didn't present it to you. What the general partners are doing at this point, they're inspecting the physical condition of the property. They assess its financial performance. They review the legal documents and evaluate the market conditions. They're checking for any potential red flags that could impact the investment, for both them and yourself. Next comes the acquisition. Once due diligence is complete and the property checks out, the general partners, they're going to negotiate the purchase price and the terms. They're going to finalize the deal. What they're doing is they're going to arrange the financing, close the deal, and then this is where the syndicate takes ownership of the property. And at this point, the limited partners, they're going to contribute their agreed upon investment capital. Next, we're on to the operation phase. And this is where the real work begins for the general partner. They manage the property, they execute their business plan, and aim to generate profits for the syndicate in general. They might be making improvements to increase the property's value, managing tenants, overseeing repairs and maintenance, or managing the financial aspects like the rent collection, expense tracking. Once again, circling back to the tenants' toilets and turnover, they're earning their keep, so to speak. And finally, we reach the exit. This is where, in this stage, where the property is sold and the profits are distributed amongst the syndicate members. The general this is actually, so to be clear, the general partners, they'll decide when the best time to sell is based upon the market conditions. But in your original PPM, they will state, the general time frame when they're going to look to exit. But they're going to determine this obviously based upon the performance of the property and obviously, circling back to what they originally promised to you. Legal structure and documentation. So this is where, if we're going to dive into this topic next, the legal structure and documentation, while it may not be the most glamorous, as talking about, returns on investments and things like that, it's a critical part of a successful investment. So let's get into it. When a syndication is formed, it's typically structured as a limited liability company, or what you'll hear as an LLC. Sometimes it'll be a limited partnership or an LP, but traditionally you're going to see most syndications formed under an LLC. Both an LLC, though, and an LP, these structures help protect the investors, from your personal assets, being at risks, from any potential liabilities associated with the property itself. At the end of the day, if a tenant is tripping, we're living in a litigious society, they want to sue the property owners, that LLC or that LP, it's structured to protect you, the investor. Now let's talk about the documents that govern a real estate syndication. And first up, what I kind of mentioned before, that's the private placement memorandum, or it's often referred to as the PPM. The PPM is a detailed document that outlines the terms of the investment, the potential risks, the business plan, and the information about the general partners. It's a must-read for all prospective limited partners, right? This is where you're really diving in. You as the investor, you need to roll up your sleeves and make sure you're reviewing this and taking it very serious. It's there to ensure that you are fully informed about the investment you're about to make. Next, we have the operating agreement. The operating agreement is the rule book for the syndication. It defines the rules of the general partners and you, the limited partners, outlining voting rights, explaining how the profits will be distributed, and it describes the procedures for various scenarios, such as, if a partner is wanting to exit the syndicate, or what happens in the event of a dispute. It's not uncommon for someone to say, man, I had some life happen to me, I need to exit this, how can I do that? That's really where it's going to break that down. And finally, we have the subscription agreement. The subscription agreement is the document you sign when you decide to invest in the syndication. It includes your personal information, confirms your status as an accredited investor if it's required, and legally it commits you to invest a specific amount of money. Now, while these documents that I just covered might seem a little bit daunting, they are crucial to protect your interest and ensure the syndication operates smoothly. Always, and I can't stress this enough, always thoroughly review the documents and consider getting advice from an attorney or a financial advisor before you're investing. It's not a bad idea to get your attorney and your CPAs in the same room as you're reviewing this. Next, let's talk about some of the benefits of investing in syndications. Obviously, the whole with them, what's in it for me? Investing in a real estate syndication comes with several potential benefits. These include potential for high returns, passive income, portfolio diversification, and certain tax benefits. All right, first up, let's talk about your returns. One of the major attractions of real estate syndication is the potential for high returns. This typically comes in two forms. One, cash flow from the rental income, and then two, the appreciation when the property itself is sold. With a successful syndication, you can enjoy a steady stream of income with the property being held and a substantial profit when it's sold. So next we have passive income. Everyone loves hearing passive, right? If you're an investor who prefers a little bit of a hands-off approach, syndications can be a perfect fit. As a limited partner, you contribute capital and share in the profits, but you don't have to get involved in the day-to-day operations or management of the property. That's the job of the general partners. It's an excellent way to earn money while freeing up time for you to get on to other adventures. Another benefit is diversification. Real estate is a great way to diversify your investment portfolio beyond just traditional stocks and bonds. Plus, within real estate itself, syndications can allow you to invest in different types of properties and in different geographical locations. Just another way to diversify within the same investment. Last, but definitely not least, we have tax benefits. Now, I'm not a tax advisor. Once again, get your CPAs in a room, but I can tell you that real estate offers some very attractive tax perks. Always consult with a tax professional to understand the tax potential implications. These can include tax deductions for depreciation, interest expense, and property taxes, among others. Now, once again, always consult with a tax professional to understand the potential tax implications. But at the end of the day, this is something that could offer you a tremendous benefit. And that's one of the reasons why to invest in a syndication. And there you have it. From potential high returns to diversification, passive income, and tax benefits, real estate syndication offers a unique and powerful way to build your wealth, period. Let's flip the coin to discuss the risks and the challenges that come along with investing in these opportunities. It's not the most fun topic, but it's crucial to make well-informed decisions. So let's get into it. Investing in real estate syndications, like any investment, comes with inherent risks. These include market risks, property risks, management risks, and the risks of illiquidity, right? You're locking in this for 3, 5, 7 years. All right, first, let's start with market risks. Real estate values and rental rates can fluctuate based upon the overall health of the economy, interest rates, unemployment rates, and other macroeconomic factors. For instance, an economic downturn can lead to lower property values and rental rates, which could impact the return on your investment. Next, we have property-specific risks. These can include unforeseen maintenance issues, unexpected vacancies, or problems with the tenants, right? All of these are potential risks. You never know when a roof a tree falls on a property. I mean, there's so many things that could happen. Now, while the general partners do their best to manage these risks, it is impossible to predict every potential issue that might arise. Next, there are the management risks. There are risks associated with the general partners themselves who actually manage the syndication, right? You're dealing with people. People are flawed, not perfect. Another risk that you have to consider. If they lack the experience, if they make a poor decision or fail to execute on the business plan that you reviewed effectively, it could affect the performance of your investment. Now, finally, we have the risk of illiquidity. Unlike those stocks and bonds that you have investments in, you can't just sell your share in a real estate syndication, whenever you want. Once again, they will outline how you can, if life happens, exit the property. It's not as easy as just selling a stock on Wednesday. Your investment is typically tied up for the duration of the syndication, which could be, once again, 3, 5, 7 years. You'll need to be prepared for this lack of immediate liquidity. While it's important to understand these risks, remember that they can actually be mitigated. This is where good due diligence, diversification, investing with experienced general partners, and being prepared for the long-term nature of this investment can help manage these risks. Now, okay, let's dive into the topic that gets every investor's heart racing: the returns, the whole reason why we're here. We're going to be discussing key terms like internal rate of return, cash on cash return, equity multiple, and the capitalization rate. Let's demystify these terms, okay? Myself as well, right? When you're first hearing these things, it can get a little intimidating, but demystifying them so that you can get a better understanding. People a lot of times won't do something because they're scared. Once you take out the mystique of it, once you actually break it down, shuck it to the cob, it's not scary anymore. And then that leads you into a way to say, hey, you know what? I do have a greater financial education now, and I feel like I can move forward in this investment. First up, we have the internal rate of return, or IRR. The IRR is a percentage that measures the profitability of an investment over its lifetime. It takes into account both the timing and the amount of cash flows, giving you a more holistic picture of an investment's performance. Next, let's talk about cash on cash return. All right, you'll hear this as well. This is a straightforward measure that calculates the cash income earned on the cash invested in a property. It's the annual return you're making on your capital before factoring in things like debt payments, taxes, or appreciation. Moving on, we have the equity multiple. The equity multiple provides a snapshot of the total return on an investment. So this is the total return on your investment relative to the total equity that you've actually invested. A higher equity multiple indicates a higher return on the initial investment. And last, but not least, let's discuss the capitalization rate. You'll often hear this as the cap rate. Hey, what's the cap rate in my investment? This is how you're going to hear about that. And actually, more often not even when you're looking at something, right? Like how someone may sell it will be based upon the cap rate. And the cap rate is simply used to estimate the potential return on a real estate investment. It's calculated by dividing the property's net operating income by the current market value. A higher cap rate typically suggests a higher risk, but also a higher potential return. These measures provide a way to analyze and compare potential investments. But remember, they're just part of the story. Always consider other factors such as market trends, the property condition, and the management quality. Next, let's step into the world of capital stacks and waterfall structures. Now, these concepts might sound complex, but they are at the heart of your real estate syndication deal. It's actually how it's structured and how the profits are distributed. So let's dive in. Let's start with the capital stack. This represents the different layers of capital that make up the financing of a real estate project. At the base of the stack, we have the senior debt. This is typically a bank loan, and it's the first to be repaid. The next layer up is the mezzanine debt. Mezzanine debt, it's a higher interest loan, and that sits above the senior debt, but below the equity layer. It's the riskier than senior debt, but less risky than equity. And it's often used to fill the gap between the senior debt and the equity in a deal. And above the mezzanine debt, we have the preferred equity. Now, the preferred equity, it's a bit of like a hybrid of debt and equity, I guess. It's preferred debt holders have a higher claim on the profits and the assets. Then they're going to have a higher claim than the common equity holders, but they typically have a capped return. Now, at the top of the stack, we have common equity. This is the riskiest layer of capital, but it also has the potential for the highest returns in a syndication. This is where the general partners and the limited partners sit. All right, so now that we understand the capital stack, let's talk about how the profits are actually distributed. This is where the waterfall structure comes into play. The waterfall structure outlines how the profits from a syndication are distributed among general partners and the limited partners. The structure is typically tiered with different levels of return, triggering different profit splits. For example, the first tier might involve returning the original capital to the limited partners, Hey, I want to get my money back. What was my original investment? That's my, first concern. Awesome. That's a potential. The next tier might see profits, split like an 80-20 between the limited partner, like 80% for the limited partners, and general partners receiving a 20% split until a certain return is reached. And after that, the profit actually might change to like a 70-30 or a 60-40, providing a greater share to the general partners. And this would be like as a reward, for their successful management of the project. Each syndication can have a different waterfall structure. So it's essential for you to understand this before investing. That tells you exactly, and this once again will be outlined in your documentation, when and how you'll get your share of the profits. The capital stack and the waterfall structures are key aspects of any syndication. Understanding them helps you make informed decisions, and that actually allows you to say, hey, this is what the deal is I want to choose or not. Pretty much that is how you're saying, okay, hey, I have investment goals lined up. Does this align with them or not? Next up, we're venturing into a topic that many people find a little taxing. That's right. We're talking about the tax implications of real estate investing. It's not the most glamorous part of investing, but understanding it can provide substantial benefits. So let's get started. First, let's talk about depreciation. In real estate, you're allowed to deduct the cost of buying and improving a property over its useful life, which the IRS typically defines as 27 and a half years for residential property and 39 years for commercial. This depreciation can offset your rental income and reduce your tax bill, which is huge. Next up, we have something you may have heard of before, 1031 exchanges. A 1031 exchange, named after Section 1031 of the Internal Revenue Code, allow you to defer capital gains tax when you sell a property as long as you reinvest the proceeds in a like-kind property. Now, this can be a powerful tool to build wealth over time by letting your money grow tax deferred. Now, let's look at opportunity zones. Opportunity zones are economically distressed communities where new investments under certain conditions may be eligible for preferential tax treatment. If you invest in an opportunity zone through a qualified opportunity fund, you could potentially defer tax on any prior gains and reduce the tax that you owe on the appreciation of the opportunity zone investment itself, which is pretty sweet. While these tax benefits can be potentially extremely powerful, it's important to remember that everyone's tax situation is different. So once again, get the CPA in the room to make sure that you're in a line and you have your together. The impact of real estate investing on your personal taxes can vary widely depending on factors like, one, your income, your tax bracket, and whether you're considered a real estate professional by the IRS. As with any investment, we recommend get your CPA in a room. They're going to have your best interest at heart. They're the ones that know your situation. They have all the years of information that they've worked with you. They're going to be able to provide great, input on, if this is a good investment for you or not. Next, let's tackle an essential topic in the world of real estate syndication, and that is due diligence. This is a stage where you roll up your sleeves and dig into the details of a potential investment. After all, a smart investor is not just a spectator, they're a detective. So let's get started. Due diligence is about answering some key questions. Is the sponsor reliable? Is the market strong? Does the property have potential? Is the business plan solid? And do the deal terms make sense? Let me explore each one of these. First, assess the sponsor's track record. Look at their past projects, their successes, their failures. Are they experienced? Do they have a history of delivering on their promises? Reach out to investors who have worked with them before. The sponsor's competence and their integrity, that's the root of it. That's it. That's paramount. Look at the area's economic indicators like job growth, population growth, and rental demand. A strong market can buoy a less than perfect property, while a weak market, they could actually sink even the most promising investment. It could look awesome on paper. A weak market's going to crush it. You need to know those factors. Now, let's consider the property itself. Does the property's condition, location, the tenant profile, does that align with the business plan? If major improvements are planned, are they realistic and budgeted correctly? Your investment is ultimately tied to this physical asset, so you want to make sure that you cover all of those. Fourthly, let's analyze the business plan. Is the plan to buy and hold? Is it a value add? Is the projected timeline and the exit strategy reasonable? Does the plan account for potential risks and market downturns? The business plan is your roadmap, so ensure it leads where you want to go with your investment. Finally, study the deal terms. Look at the structure of the deal, the projected returns, and the fee structure. Do the terms align with market norms? And do they seem fair given the risks? Understanding the terms can help you avoid surprises down the line. Do the due diligence. Listen, due diligence can be a lot of work, but it is a crucial step in making a confident investment decision. It's not just about the property or the business plan, it's also about the bigger picture, the economic and market trends that can significantly impact your investments. I also want to dive into how factors like interest rates, job and population growth, and other trends can shape the success of a syndication. All right, so let's go over this. To begin with, let's talk about interest rates. Interest rates impact borrowing costs, period. When interest rates are low, it's less expensive for sponsors to finance property purchases, and that's going to potentially boost your profits. But when the rates are rising like they are now, financing costs increase, and that's going to eat into your returns. What about job growth and population growth? Why should you, the investor, care about these? These factors are crucial for demand. Areas with strong job growth tend to attract more people, increasing the demand for housing. This can drive up property values and rental rates, benefiting you, the investor. Now, on the flip side, areas with stagnant or negative job growth are going to see weaker demand. Think vacancy. That's not all. There are other trends investors should keep an eye on. Now, these can include broader economic trends like GDP growth or inflation, real estate market trends like supply and demand dynamics, and even demographic trends like the aging of the population or shifts in lifestyle preference. It's huge. A lot of people don't want to own homes now. They want to rent, which is awesome for you, the investor, right? All of these things can influence performance of real estate investments. As an investor, it's essential to understand these factors and how they might impact your syndication investment. It's not just about picking a good property or a reputable sponsor. It's also about understanding the broader context in which your investment operates. After covering so many aspects of real estate syndication, it's time to answer a crucial question. How do you get started? I'm going to cover a couple practical steps to finding a syndication, finding the right opportunities, the right questions to ask the sponsors, and important legal and financial considerations. So let's just jump into that right now. Firstly, finding syndication opportunities is a mix of networking, research, and being proactive. You need to go out there and attend real estate investor meetings, connect with other investors online, consider joining investor groups. There's websites that actually cater to syndication deals and can also be a valuable resource to you. Heck, go to MRTGcapital.com. We have investor resources for you there. But a big one that's almost, is considered the go-to in the industry, biggerpockets.com. And once you find a potential deal, it's time to interview the sponsor. Ask about their experience, their track record, what's their strategy for the specific deal that you're looking at. Understand how this sponsor handles risks. What's their contingency plans? It's also essential to understand that communication style that they're bringing to the table. You want a sponsor who will keep you informed about your investment, plain and simple. Now, let's discuss the legal and financial considerations. Ensure you understand all the terms of the deal, including the structure, the projected returns, and the fee arrangements. Remember, in syndication deals, you're pooling your money with others, so you need to be comfortable with this arrangement. Legally, you should review all documents thoroughly. These typically include the private placement memorandum, the operating agreement, and the subscription agreement. And here's a pro tip. Don't hesitate to hire a legal or financial advisor specifically for this in and of itself. If you're unsure or don't have the background in this, remember, your money's the one at stake, so you want to bring the best at the table to ensure that you're making a solid investment. Working with experienced professionals can help you navigate the complexities and make sure your interests are protected. Getting started with real estate syndications is an exciting journey, but remember, it's not a sprint, it's a marathon. Take your time, do your research, and make informed decisions. Now, after you've invested in a real estate syndication, what comes next? How do sponsors keep you in the loop? What updates can you expect, and what kind of transparency should you demand? Let's pivot into discussing investor relations and communication. Communication is a key aspect of a healthy syndicate relationship. A good sponsor should keep investors updated on the property's performance, their financials, and any issues that might impact the investment. So what kind of updates can you expect? Most sponsors provide regular, we'll just say regular reports, usually on a quarterly basis. Some may be monthly, but more often than not, you can expect reports on a quarterly basis. These reports might include details on the rental income, expenses, the occupancy rates, and any major maintenance or renovation activities that are taking place. Some sponsors also hold periodic conference calls or webinars to discuss the property's performance and answer investor questions. For example, from our company, you can expect just that. We're going to hold regular webinars with you so that you're in the loop. What about transparency? How open should sponsors be with their investors? Transparency is paramount. I'll say that again. Transparency is paramount. As an investor, you have a right to know how your money is doing, how it's being managed. Good sponsors will be upfront. They'll let you know about any problems or setbacks and will communicate their plans to address them. Now, what should you do if you're not getting the level of communication that you need? Listen, don't be shy about asking for more information. If you're not getting the updates that you need, or if you have questions about the property or the business strategy, reach out to your sponsor. A quality syndicate will value your engagement as the investor and will be responsive to your inquiries, right? This is a partnership. It's a long-term partnership. You have to have a good partner. Investor relations is about more than just updates and transparency. It's about building a relationship of trust between the sponsor and the investor. So remember to communicate, ask questions, and stay involved. Let's move on to the all-important topic of exit strategies. You've invested your money, you've held the property, and hopefully you've seen some great returns. But what's next? How and when do you exit? And what does that mean for you, the investor? Let's find out. Real estate syndications typically have a holding period often between 5 to 10 years, during which the property is improved, rents are increased, and value is added. The exit strategy is what happens after that holding period. The most common exit strategy is simply one to sell the property. In an ideal scenario, the property is sold for more than the purchase price plus any improvement costs. This is where you, the investor, can see significant returns, especially if the property's value has increased substantially during the holding period. Another possible exit strategy is refinancing. If the property's value has increased, the sponsors may choose to refinance the property, taking out a new loan based on the increased value. This can free up cash that can be then distributed to investors, often while still retaining your ownership in the property. All right, so what all does that mean for you, the investor? The exit strategy is where you'll typically see the bulk of your returns. Whether the property is sold or refinanced, this is usually the stage where the value that's been added to the property gets converted into cash returns. Remember, exit strategies should be part of the discussion from the start. Before you invest, make sure you understand the sponsor's planned exit strategy and the implications for your investment. To wrap things up, we've covered a lot as it relates to real estate syndication. And I know if you're like me, you could be left with even more questions. My partner, Mike Rahm, and I will be creating many videos just like this to deep dive on specific facets of real estate investing and real estate syndication. If you would like to connect, please head on over to our website, MRTGcapital.com, and request time to meet with us to answer any questions you may have about real estate investing through a syndication. We partner with small groups of investors just like you, and we're always reviewing deals that could be of interest to you. Thanks for watching. It's greatly appreciated. And if you enjoyed the content, please make sure to subscribe. We'll see you on the next video, guys.